All right, today we are doing a deep dive into one of the most explosive and maybe one of the most overlooked stocks in the entire AI sector, Credo Technology Group. So what's really behind its insane run-up? And is there any fuel left in the tank? Let's get into it. Okay, first things first, just look at these numbers. Over the last 5 years, the NASDAQ has delivered a pretty solid 71% return. Not bad at all. But Credo, ticker CRDO, has put up a mind-blowing 1,306% gain. I mean, that's not just beating the market, that's playing a completely different sport. And it immediately makes you ask that question you see right there on your screen. Did we all miss the boat on this one?
Well, to answer that, we've got to go deeper than just a stock chart. We really need to look under the hood here and figure out what makes Credo such a powerful and honestly, such an unusual player in this whole AI game.
So where is all of this performance actually coming from? Well, the answer isn't in some glamorous new AI model or a flashy piece of software. Nope. It's much deeper. It's in what you could call the plumbing of the entire AI infrastructure.
The core technology here is something called active electrical cables, or AECs. Now, I know that sounds super technical, but the idea is actually pretty simple. Think of them as the advanced nervous system for a data center. They're these specialized copper cables that actively boost data signals to make sure information is flying between servers with incredible speed and almost zero delay. They are, quite literally, the backbone.
And this right here really paints the perfect picture of Credo's role in this AI gold rush. You see, they're not out there digging for gold. They're selling the mission-critical picks and shovels. Their cables are the unseen hardware that connects thousands upon thousands of servers for cloud giants like Amazon Web Services, making the entire AI cloud we rely on even possible. And they don't just sell these things, they absolutely dominate the market. I mean, look at this. Credo controls a staggering 70% of the entire market for AECs. In a rapidly growing, absolutely essential industry, that's not just leadership, that's a near monopoly.
So how do they build this kind of dominance? Well, a huge advantage is efficiency. Their tech is 50% more power efficient than other solutions out there. For a massive data center where the electricity bills can easily run into the millions, a 50% reduction isn't just a minor tweak. It is a game-changing competitive and financial advantage.
But their real technological advantage, their moat, if you will, comes from solving a very, very expensive problem. It's called link flap. Just imagine you're spending weeks and millions of dollars training a huge AI model. If the connection between your servers drops for even a microsecond, the entire training process can be ruined. All that time, all that money, just gone. So yeah, a simple link flap isn't just a small glitch. It's a potential multi-million-dollar catastrophe. In Credo's solution, it's their proprietary ZeroFlap technology, which is engineered to guarantee maximum uptime and pretty much eliminate this risk. For their customers, this kind of stability isn't just a feature, it's priceless insurance.
Now, dominant technology is one thing, but has that actually translated into a healthy business? Let's pivot to the company's financials, because this is where the story gets really, really compelling. We are looking at a true financial inflection point. This chart tells such a powerful story. It's a massive turnaround. Just look back at 2021. The company was burning cash with a negative 47% net margin. Ouch. But since then, they've crossed that critical zero line right into profitability. And looking ahead to 2025, they're projected to hit a healthy net margin of almost 12% on revenues that are just soaring. That is what a textbook inflection point looks like.
And to put that revenue growth into perspective, let's just lay it out here. From just over $50 million in revenue in 2020 to a projected $436 million in 2025. You know, that is the kind of explosive, exponential growth that makes Wall Street sit up and pay very close attention.
So how do they keep this incredible momentum going? With big strategic moves. They recently made a $1.3 billion deal for a company called DustPhotonics. And this is like the perfect puzzle piece. It merges Credo's dominance in short-reach copper cables with DustPhotonics' expertise in long-reach silicon photonics. And this isn't just about getting bigger for the sake of it. It is a strategic power-up. First, it expands their product reach all the way out to 2 kilometers, which opens up totally new parts of the data center market. Second, it's expected to give their gross margins a nice boost. And finally, it puts them on a clear path to cross $500 million in revenue by 2027. This move is all about securing their dominance for years to come.
Okay, so we've got a fundamentally dominant company. They have a near monopoly, incredible technology, and explosive financial growth. It really sounds like the perfect investment, doesn't it? But that brings us to the most important question of all. Is it priced for perfection?
And this right here is the catch. The market sees all of this good news too. The stock is trading at a significant premium. That warning sign says it all. There is absolutely zero margin for error here. Any tiny hiccup in their execution or even just a market downturn could hit a stock with such high expectations really, really hard.
Let's put a hard number on that premium. The stock's price-to-earnings ratio is sitting at a sky-high 87.46. Now, just for some context, the S&P 500 average is usually somewhere around 20 to 25. Even a lot of high-growth tech companies trade for less than this. You're paying a very steep price for all that future growth.
And here's another metric, price to book, which basically compares the market price to the company's net assets. It tells the exact same story. It has surged from 4.7 times back in 2022 to 12 times today. That means the premium the market is willing to pay has almost tripled in just a couple of years.
So where does all this leave us? Well, on one side, you have this undeniable fundamental dominance. On the other, you have a very demanding premium price tag. When you weigh their AI plumbing monopoly against that 87x PE ratio and zero margin for error, our verdict becomes pretty clear. This is a hold, or maybe a stock to accumulate on dips. Which brings us to our final question. For you, Credo is without a doubt a phenomenal company with a fortress-like position in a critical market, but its stock is priced for absolute, flawless execution. Any stumble could present a much better entry point. So the question is, will you be waiting for the dip?